My name is Syukri bin Muhamad from DBS 16. Today, I will present about liquidity ratio. Under liquidity ratio, we have current ratio and quick ratio. So first, let me explain about current ratio. So the current ratio is a liquidity ratio that assesses a company capacity to pay short-term or one-year obligations. It explains to investor and analysis how a firm might use current assets on its balance sheet to pay off current debt and others obligations. So the formula for current ratio is current assets divided by current liabilities. For Muhamad, current assets amounted to 4,400,000 and their current liabilities is 2,200,000. And then we got the value of 2. Then we can see that industry have a value of 2.1. And then from that, we can say that Muhamad's value is on the par of the industry. So that we can say that Muhamad is still able to pay their short-term debt. So this is our recommendation for to improve the ratio. The first one is use cash to reduce current debt. Secondly, delaying capital purchase that involve cash payment because we want to maximize our current assets so that we hold first the current asset to ensure the availability of the current assets so that we can improve the ratio. Next, I will explain about quick ratio. So quick ratio is the fast liquidity ratio is calculated by dividing a company's total quick assets by its total net liabilities and reinsurance liabilities. This is one of the most true methods for determining a debtor's ability to repay current debt commitments without the need for external financing. The formula for quick ratio is current assets minus by inventory and then minus by prepayment. And then divide by current liabilities. For Muhamad, current assets amounted to 4,400,000. Then minus by 1,310,000. And then minus by 490,000. And then divide by their current liabilities amounted to 2,200,000. And then we got the value of 1.18. So as you can see, the industry got the value of 0.9. That we can say that Muhamad got highest value for quick ratio. So it shows that they are able to pay their current debts. So this is our recommendation to improve the ratio. The first one is increase sale and inventory turnover. Secondly, pay short-term liabilities quickly. That's all from me. Thank you.
My name is Nur Izzati binti Ishar, and I'm going to explain to you about the efficiency ratio and asset management ratios. The first one we got here is inventory turnover ratios. The purpose of the inventory turnover ratio is used to determine whether or not sales are sufficient to turn on consumed inventories. A high asset turnover ratio indicates that the company makes efficient use of its asset, whereas a low ratio indicates that the company makes wasteful use of its asset. As you can see at the calculation, there's sales divided by inventories. The sale is for 70 million divided by the inventories 1.31 million, and the Muhamad got 12.9898. The comparison between the company which is Hikmabati, and the industry itself, there are a large differences where Hikmabati got 12.98 and the industry got 6.5. That means Hikmabati has a better ratio than the industry itself. To improve the ratio for inventory turnover ratio, Hikmabati can do a proper forecasting or they can do a smart pricing strategy. So next, we are going to proceed with average collection period. The purpose of average collection period is for measuring how effective the firm is managing its asset in order to generate sales. It also shows efficiency in collecting debt. For the calculation is account receivable divided by sales and needs to multiply by days for a year, which is 365 days. Account receivable 1.7 million divided by 70 million multiplied by 365, and Hikmabati got 37 days. Compared to industry, they got 35 days. That means Hikmabati is a bit lacking in collecting debt when compared to the industry. So Hikmabati can improve their ratio by offering discount and payment plans. They also can prioritize collection efforts. So next, non-current asset and turnover, non-current asset turnover ratios. So the purpose is a management efficiency ratio is non-current asset turnover. It calculates the revenue generated per unit of non-current asset over the course of a year. The following formula is used to calculate non-current asset turnover, non-current asset revenue. The calculation is sales divided by non-current asset. Sales, which is 70 million divided by non-current assets 6.8 million, and Hikmabati got 2.5. Compared to industry, Hikmabati got a little bit higher ratios than that compared to industry. So Hikmabati can improve the ratio by selling assets or leasing instead of buying assets. So next, total asset turnover ratio. The purpose is asset management ratio are essential for determining how well and efficiently your small firm manage its asset to generate revenue. Turnover ratios and efficiency ratios are terms used to describe asset management ratio. Your operational capital will be too high if you have too much invested in your company's asset. So to calculate this one, we need to do is sales divided by total asset, which is as you can see, 70 million divided by 11.2 million, and Hikmabati got 1.52. Compared to industry, industry got a slightly higher ratios than Hikmabati, which is 1.6. So to improve the ratio, Hikmabati can increase asset or improving the efficiency of the use of the assets. So that's all for me. Thank you.
Hi, Assalamualaikum. My name is Muhamad Akmal. So I'm going to present about leverage ratio. Okay, debt ratios. The purpose of debt ratio is a measurement of a company's indebtedness in terms of total debt to total asset. The debt to equity ratio varies greatly by industry, with capital-intensive enterprises having substantially greater debt to equity ratio than others. The debt ratio of a firm is determined by dividing total debt by total asset. So as you can see the calculations, how to get the total debt dividing by total asset times 100. So 3.4 million divide by 11.2 million times 100, and you will get 30.36. So next is comparisons. Comparisons, like you can see, the company gets 30.36% and industry got 40%. This show the
ratio, improve the inventory management, and secondly, restructure debt. Moving on to the debt equity ratio. Debt equity ratio purpose. The debt to equity ratio is a financial statistics that show how much debt and how much equity are utilized to fund a company assets. The ratio is also known as risk, gearings, or leverage, and is closely related to leveraging. Next is calculations. Total debts divided by total equity times 100. 3.4 millions are divided by 9 millions and times 100, and we get 337.78. So the comparisons between the company and industry. The company we get 37.78 and industry we got 60. This show how the greater is industry than company. The improved ratio is increased profitability, and the last one and pay down and loans. Time interested and the purpose of interested and is coverage ratio is known as the times interested earn ratio is a measure of a company ability to pay its debt on time. EBIT or EBITDA divided by total. Interest expenses is one way to calculate it. So how the calculations? Earning before interest and tax. EBIT divided by interest. 2.4 millions divided by 360,000, then you will get 6.67. The comparisons with the company and industry, the company gets 6.67 and industry gets 7. So the next is improve ratio, use greater levels of equity, and secondly, increase earning. Thank you. That's all from me.
Okay, now I will talk about profitability ratios. So I will talk about gross profit margin, and the purpose is the gross profit margin ratio, also known as gross margin ratio, is a profitability ratio that compares a company's gross margin to its sales. The phrases sales and in accounting are used interchangeably. It depicts how much profit a business makes after deducting its cost of goods sold. So the calculation is gross profit over sales times 100. Okay. Like this is the gross profit is 7,200,000 divided by 17 million times 100 equals 42.35. In comparison, a company has 42.35% and industry has 38%. So to improve the ratio, to improve the ratio in gross profit margin, we must increase the prices and increase the average order value. So the next is operating profit margin. Okay, the purpose of operating profit margin is a profitability or performance ratio that indicates the percentage of profit generated by a company's operation before taxes and interest charges are deducted. It's computed by dividing total sales by operational profit. So the calculation is earning before interest and taxes divided by sales times 100. Okay, this is the calculation with numbers. 2,400,000 over 17 million times 100 equals 14.12%. So the comparison for company and industry. For company, we have 14.12%, and for industry is 18%. And to improve the ratio for operating profit margin here is we must reduce cost of goods, automate, and the second one is automate specific tasks in business. Okay, I will talk about the net profit margin. The purpose is a profitability statistic that measures a company's profit as a portion of revenue or net sales. it takes into account of all the company's expenses, not only the cost of goods sold. So for the calculation is net income divided by sales times 100. And the example given is 1,530,000 over 17 million times 100. And the answer is 9%. Okay, so comparison for company and industry, the company has 9% and industry has 8%. And to improve the ratio also, we must increase the prices and decrease operating costs. And next is return on asset ratio. Okay, ROA is a profitability ratio that shows how much profit a business may make from its assets. In other terms, ROA is a metric that assesses how effective a company's management is at making a profit from its financial resources or assets on its balance sheet. So the calculation is net income divided by total assets times 100. And the net income is 1,530 over 11,200,000 times 100 equals 13.66%. And comparison for company and industry, 13.68%, and for industry is 12%. And to improve ratio is increase net income to improve ROA and decrease total asset to improve ROA. Okay, increase net income and decrease total asset to improve ROA. Okay, the next one is return on equity. Ratio of return on equity, ROE, is a profitability ratio that assesses a company's capacity to profit from its shareholders' investments. In other words, the return on equity ratio illustrates how much profit is generated for each dollar of common stockholders' equity. And the full calculation is net income divided by ordinary share times 100. And as you can see, the example here is 1,530,000 divided by 40 million times 100 equals 38.25%. And the comparison for company and industry, for company, we have 38.25%, and for industry is 20%. And to improve the ratio is we must use more financial leverage and increase profit margins. Okay, so now I will talk about marketability ratios. The first one is earning per share. The purpose is a financial ratio calculated by dividing net income by the total number of issued common shares. Investors use EPS to assess a company's performance and profitability before investing. And the calculation is net income available to common shareholders divided by numbers of ordinary share issued. And for example, is 1,530,000 minus 140,000 divided by 4 million equals to 0.35. And the comparison is for company, we have 0.35 and industry is 0.28. And to improve the ratio is buying back own shares and key takeaways. The second is dividend per share. The purpose is the current share price of publicly held company stock is evaluated using market value ratios. Current and potential investors use these measures to judge if a company's shares are overpriced or underpriced. Below are the most typical market value ratios. The first and for the calculation is dividend divided by number of ordinary share issued. Okay, as you can see, is 600,000 divided by 4 million equals to 0.15. And for comparison, company has 0.15 and industry has 0.14. And to improve the ratio is increase in the company's net profit, out of which dividends are paid, and shift in the company's growth strategy. The next one is dividend paid out ratio. The purpose is computed by dividing the annual dividend per share by the profits per share EPS, or by dividing dividends by net income. And the calculation is dividend per share divided by earning per share times 100. As you can see, 0.15 divided by 0.35 times 100 equals to 42.86. Okay. For comparison, company has 42.86% and industry has 30%. And to improve the ratio is increase in dividends and monitoring dividend payout ratio. Okay. Now I'll talk about price earning ratio. The purpose is proportion of a company's share price to its earning per share. The ratio is used to determine the worth of a company and whether it is overpriced or undervalued. The calculation is marketing price per share divided by earning per share. For example, 3.4 divided by 0.35 equals to 9.71%. 9.71. No percentage. And comparison is for company 9.71 and for industry 8.5. And to improve the ratio is by economic growth and low inflation. The next and final one is dividend yield. The purpose is a financial ratio dividend or price that illustrates how much a firm pays out in dividends each year in relation to its stock price given as percentage. And for the calculation is latest annual dividend per share divided by current price market per share times 100. And as you can see, 140,000 plus 6 million divided by 4,200,000 divided on and divided by 3.4 times 100 equals to 5.18. And to compare by company and industry, the company has 0.05 and industry has 5%. And to improve the ratio is we must increase its dividend and share price must fall. Okay, now I will talk about limitation of ratio analysis. Okay, they have 5 limitation of ratio analysis. The first one is industry average may not provide a desirable target ratio. The second is problem of price level changes, inflation may distort financial statement. The third one is a high or low ratio does not automatically lead to a specific decision. The fourth one is accounting practices differ widely among firms. And the fifth one is manipulation of financial statements. So for me, now let's go to Syukri to talk about B.
So next, we will answer the question given. So the question is, as an officer of Al Rajhi Bank, would you accept loan application from Hikmat-Bati? Our answer is, as an officer of Al Rajhi Bank, I will approve loan application from Hikmat-Bati because of, firstly, Hikmat-Bati had higher quick ratio value than industry. From the analysis, we can see that Hikmat-Bati able to repay his current debt and can decrease his other commitment on the current debt. Secondly, because of Hikmat-Bati is on the average of industry current ratio value with 2 for Hikmat-Bati and the value of 2.1 for industry. From the analysis, we can say that Hikmat-Bati able to pay their short-term debt because of his good liquidity on current asset. And lastly, Hikmat-Bati had lower debt ratio than industry. It shows that the firm total liabilities is lower than total asset. From the analysis, we can say that the company able to pay off its liability with its assets. That's all from us. Bye.